After the U.S. got a credit downgrade, the market took an absolute beating. Riz and I are going to give our thoughts on what's going to happen in the market this week, especially with earnings on the horizon. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. My name is Chris. I'm part of Riz International, and we are a group of traders who are looking to trade in the market and gain financial independence and help our money work for us. That is the goal of every trader. When you are trading in the market, you obviously want to extract that alpha, and there's no one better than that than Riz himself. How are you doing today, brother?
Doing good, Chris. Good to be on.
Oh, it's great to have you back. We missed you last week, but I know you were busy out and about, so we are glad to have you back. And it has been quite a week, to say the least. Huge news coming out on Wednesday, if I'm not mistaken. We had the credit downgrade for the United States, and the market took an absolute dive. And Friday especially was very wild. We opened up, we were going green for a while, and not until, we kind of got later in the day did we really start selling off hard and pushed right below that 4,500 support level. That has been a very key area in the past, and we kind of breached that in a very bearish fashion. Riz, obviously there's a lot of things going on in the market right now, but do you think we've got more downside with this credit downgrade, or do you think we've seen the worst of it?
Yeah, so the credit downgrade, and Warren Buffett said this, Jamie Dimons, which is the CEO of JP Morgan Chase, obviously one of the largest US banks. He's also said this, so I echo their sentiment, which is, if you haven't heard, they pretty much are in agreement that this credit downgrade, yeah, it hasn't happened since I think 1994, 1996, the last time the US had a downgrade. But in grand scheme of things, they're saying it doesn't matter. And I would agree with them. I don't think it's that big a deal. Yeah, it's not uncommon to have a little bit of a reaction from the market. It's not good news, right? Like, I mean, it's not like if you get an A plus and all of a sudden the teacher's like, whoa, no, now you're at an A. I mean, it's not good news, but it's not like, oh, you're a failure or something, right? It's not ideal, but it also makes sense because we know that there's a lot of stuff that goes into defining a credit rating for a country. Obviously, it's really high level. It's not looking at just one variable, but ultimately Fitch, the credit rating, decided to move the US credit rating from AA plus to, I believe, AA, if I'm not mistaken, or either it's AAA plus and then down. They literally got rid of the plus. So not the end of the world. It's not like, the US is in any danger of all of a sudden losing its stature as the largest economy or the most stabilized and most sought after sovereign debt, which is Treasury. These are still, it's the most stable, most safest, most relied upon debt product in the world. And that's a fact. It still continues to be the fact. But we did see a little bit of a pullback. Whether directly attributed to that credit rating or not is still up to debate, because we did have some earnings as well. And the biggest, most, I would say, prominent company in the market, which is Apple, did not do too well post earnings. And they had their third quarter in a row of declining sales, courtesy of a slowdown in iPhone sales. And of course, as an iPhone user since 2008, 2009, I can tell you, obviously, with all things technology, the innovation's kind of slowed. There's only so much you can innovate, right? There's so much you can do. So yeah, Apple is a phenomenal company. It was definitely overvalued, in my opinion. It was definitely overextended, and I did not chase or buy it. And here we are, with a nice, what is it, a 4.5%, big drop for Apple this year. Yeah, 4.8%. Thank you, Chris. That's a large drop. You can see that usually Apple does not move that big. And whenever it does move, it moves up. So this was a welcome change. I'm not upset about this. Obviously, people that hold Apple long, yeah, not ideal for them. But what softened the blow was Amazon. I can assure you, if Amazon did not have the day it did, which was up about 8%, it was earlier in the day up about 11%. And you can see in that candle, kind of retraced back lower. But if it was not for Amazon, holy, we would have had probably one of the worst days in the index all year. I can say that without a doubt, just because of how big Apple is. When you have literally the largest constituent of the S&P 500, which is market cap weighted, and you have that massive company drop, 5%. And I think it lost like $100+ billion market cap just on Friday.
That's
That
rough.
takes a big, big gut punch to the market. So Amazon softened that because Amazon itself went up about maybe 180, 90, I think maybe around 100 billion as well. It is smaller, but still a juggernaut from a market cap standpoint. So it sheltered, it sort of insulated, softened that drop in the market. Otherwise, oh boy, I've been saying this all year. It's like the entire market is really where it is because of we got Amazon, we got Apple, of course, we got Meta, which has made a tremendous, rebound about nearly 200%, I think, since the lows from last November. We've had Netflix, all these companies, 255%. Thanks, Chris. But like, it's been tremendous that these companies are the ones that have been leading for the majority of the year. So again, Netflix has done well, but we also have, others. But ultimately, it's been a very, I would say, small basket of shares in the grand scheme of things that have led this year's recovery. And that is on shaky ground, especially after Friday. Ding, 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 Apple, right? So I think this is not just obviously as simply attributed to, credit rating downgrade as may seem first glance.
Let's move on to the different market sectors, and you can really see that Apple hit there. Obviously, tech was taking a bit of a beating before, but on Friday, that huge move down there, you can see that Apple really drug that down quite a bit. Communications taking a little bit hit as well, while consumer discretionary kind of popped up. That Amazon giving you a little boost there.
Yep.
Definitely helping out, make sure that the market did not really go down bad. Obviously, we still have a lot of things underperforming the market at this point. Utilities is taking a beating right now. Healthcare, real estate. Let's see, we got consumer staples, financials, and energy still all underperforming the market, which is up 16.24% at this point. So, you can really see when you get into this breakdown here, when we have those big movers like Apple, like Amazon, it really moves that index quite a bit. And I think that this shows it very well.
Absolutely. Yeah, that sector performance is great. Like Apple, communications and tech completely dropped, and then consumer discretionary with Amazon in there just lifting that up. So it was very a big divergence there, but interesting to see because they're like literally when we look at these sectors, we're looking at the internals of the broader market.
Definitely. All right, let's keep moving here. Oil has been on a bit of a tear as of late, really pushing up here. It's still within our little channel that we've had for quite some time, but coming up to the top here, we kind of peaked here around, let's see, April. We're kind of getting really close to that April peak. And gold is basically just moving sideways at this point. Really nothing too exciting here to report on gold. But yeah, Riz, oil moving pretty solid here. I know we've talked about this before, but yeah, I think we're definitely very bullish on oil here.
Yeah, very bullish. Obviously, looking at the chart, we do have some energy exposure in terms of open trades and for myself and an elite. So you guys know what that is, and although it's not moving 1-to-1 with oil, I think it's recovered a little bit. So we have that trade open. I think we're really hitting up against that 85-ish resistance area, like you have pointed out, Chris. Big tear in the run up in oil, primarily as Saudi continues to reaffirm and kind of speak and say that more cuts, we're committed to this, yada yada. which is quite the scenario that we're in because we're coming to, sadly, the end of the quote unquote summer months, depending on where you live. But it's really kind of a scenario where we've seen inflation come down to 3% annualized. One of the biggest factors being because of oil prices down. And as a result, obviously reflected at the gas pumps as well. What happens when we have this kind of move going from around $70 a barrel to $80, 85 even, and it stays that way? I assure you that's obviously reflected at the pump as well. And I assure you that is going to factor in on a negative standpoint towards the next inflation print if it stays this way. So a little bit of a question mark type of scenario, because a little bit of a negative from an inflation standpoint that could keep inflation levels elevated longer than anticipated oil.
Yeah, no, I definitely know I'm paying more at the pump. I just had to fill up before we started the webinar, and it was definitely a painful experience to say the least. Let's take a quick look here at the bond yields and the US dollar index. So bond yields taking a bit of a dip with the market on Friday, but still we have this inversion where the 2-year is quite outperforming as far as yields are concerned over the 10 and the 30-year. The dollar, after taking this, well, for lack of a better term, unknown dip here, has seen quite a rebound. And as we just continue to reaffirm, we are, feeling pretty good about this. We're not concerned about, the dollar at this point, even though anybody who does a search on YouTube will find 10,000 videos telling you how the dollar is dying, but it sure looks alive and well here. Riz, do you have any comment on these?
No, I think you nailed it. Yield curve inversion remains. We have, and I'm going to touch on that at the end. Actually, I'm going to go into my little macro views after we're done the Q&A. But I feel like you pretty much touched on it all. Yield curve inversion, we've seen a little bit of a decrease in yields. I don't think that's a big deal. I think the bond market is definitely signaling something there. And of course, the US dollar kind of picking back up isn't surprising after last rate hike.
Yeah, definitely. And if you are here on the live webinar, please go ahead and post your questions rather in the chat. But there are definitely some important dates coming up this week as well as earnings. So let's do important dates first, because that's how we usually do it here. We've got some big ones this week, guys. On Thursday is going to be a big day. We got core inflation rate year on year and month on month, as well as the inflation rate. And then on Friday, we've got PPI, excuse me, which is the producer price index, if I'm not mistaken, for July. That's another big one that people don't talk about as much because they like looking at the CPI instead. And then Michigan consumer sentiment. Well, no offense to my Michiganders out there, but this isn't going to move the market. But these other ones definitely can. So yeah, definitely a big day on Thursday, and still a pretty decent catalyst on Friday with earnings on top of that.
Yeah, we were still in heavy earnings season. Yeah, maybe most of the heavyweights like Apple, Amazon, Microsoft, Google have all Meta. They've all kind of released already, but we do have some, especially some of the smaller growth stocks still reporting this week. So earnings season continues. I think after this week is when it kind of really starts fizzling out. But yeah, earnings week plus this Thursday, potentially Friday. It remains to be seen. As you can see, the forecast plus consensus for the inflation numbers coming in remains to be seen. 3% was the previous inflation number. Consensus is showing 3.3, and then forecast is 3.1. That means they're saying maybe it ticks up a bit annualized. I don't know. I think we might come in line. Again, if we don't, and it actually comes up higher, oh boy, that's not going to be too ideal. But if it does come in below expectations, then I think the market would take that as a bullish scenario.
Definitely. All right. So we were talking about it. Let's take a look at earnings here. We've got some big names reporting, but not as big as Apple and Amazon. Monday looks fairly clear. Berkshire Hathaway is going to be a pretty big name if you ask me. The people will be watching. We don't talk about this ticker here, so we're just going to leave that alone. But definitely got some big ones on Tuesday. We've got UPS, we've got Lilly. If you like playing BS stocks, there's AMC, so enjoy that. Day traders like TWLO, I know that from my day back in the day. Let's see what else we've got. Sony's not going to be too much. Obviously, if you like burgers, here's Wendy's. But then we got Disney on Wednesday. That's going to be a pretty big one. And let's see. Not seeing a whole lot else. Was there anything else that I missed on there, Riz?
No, I think you touched on all of them. I think you're right. Pretty much a couple big ones, like, we got UPS, Lilly, and Disney are the main ones that I'd be more focused on personally.
Yeah.
And then obviously the other stuff is more growth, smaller, relatively speaking. And maybe you have a position in something, maybe it sticks out to you, but otherwise I feel like it's definitely a slower kind of week from an earnings standpoint.
Yeah, definitely has calmed down quite a bit, especially from that big day on Friday. And I will tell you guys, I told you on webinar it was going to be a big day, and I was not wrong. So Apple and Amazon made me a profit on that one. So I'm pretty happy with that. I did not say which way it was going to go, but I said it was going to be a big day.
Right on.
But Jeffrey has a question coming in here. Not a particular name, but generally I'm seeing a lot of bigger traders like Buffett and Riz, obviously, pretty heavy in cash positions. I'd love to know your stance on markets going forward into Q3 and Q4. Spectacular question. Riz, what's your take?
Fantastic. Actually, Jeffrey, it's funny you mentioned, because this brings me and segues me into the next kind of bonus part of this webinar, where I wanted to kind of talk about my thesis, my overall views, and kind of feeling that I have around not just markets, but overall in terms of the economy on a macro larger scale. So I want to bring up a few key points. So like, you're absolutely right. There's quite a few funds, Warren Buffett, obviously the legend, with sizable cash positions. Now, it's not unheard of to have larger cash piles for Warren Buffett and for myself, but this is definitely one of those elevated levels. Like, it's not common for me to have this much cash in a trading account. So why am I doing that? Well, there's a few reasons. Personally, I will start off by saying that I feel like this market is quite a bit overdone. I feel like even before Friday, and even after Friday, I would say even after this dip brought to you by Apple, I think it's still overdone. I think rates are at these levels, and we may not get another rate hike. Maybe we do, maybe we don't. Chances are still kind of a toss-up for now. But even if we don't, doesn't mean rates are going down right away. I feel like this is something that the market hasn't priced in. Kind of like, I'm not saying it's one-to-one, but it kind of reminds me of the time in 2020, as you all remember, in March, when the market dropped like an absolute waterfall. There was a time in between, before March 2020, where things were just continuing along leading up to March. They were just continuing along. You could easily look at the market in February 2020 and be like, all right, what's a big deal, right? And I feel like it's not one-to-one. It's not an exact, very different circumstances, but I feel like the market, just like it hadn't priced in COVID, it hadn't priced in that, sort of event. I feel like the market isn't pricing in the ability for the economy to take a turn for the worse. Now, does it mean we're going to have a crash? Does it mean we're going to have something like a 2008 collapse, or like an asset bubble collapse, or anything like that? No. What I do feel is that we're due for a few key things to happen, and I'll tell you a few things that could lead up to it. So number one, we know that the credit rating went down. I wouldn't classify that as a big deal, but it is an event. It is an event. It is not a bullish one. At least we can say that. Another one is benchmark rates are at 5.25%. So US interest rates are at 5.25%. The last time they were at this level was in 2001 and 22 years ago. Like, I'm 32 now. I was 10 years old the last time rates were there. I didn't know what interest rates were. I didn't know what inflation was. I didn't know what the difference between macro and microeconomic. Like, I had no idea. Okay, maybe some of you did, but I didn't. So it goes to show you that we are in a different economic environment. To assume that things will be the same for the next 2 years, 1 year, 5 years, just like they've been in the last 5, to make that assumption would be futile. I think that's my view. So we have to look at the bigger picture, and the bigger picture is, with rates at these levels, the whole picture of using your capital to take risk with, which is the market, trying to make a risk-adjusted positive return, gets turned upside down when you have benchmark rates at 5.25%. Why? Because now, because of the benchmark rates being 5.25%, 5%, you can make a quote unquote risk-free rate of return via treasury bonds, so on and so forth, pretty much around 4%. So the equity risk premium is not as worthwhile anymore. It's actually horrendous. And this is coming from someone who only participates in the capital markets, stocks, equities, options. I don't hold bonds. I don't hold treasury bonds. I don't plan to. So I can still tell you that the risk premium there isn't worthwhile as an equities and options trader. So that's the honest truth. You have to weigh the pros and cons. So for those of you that are understanding high level what I'm saying, it makes it less worth taking the risk when you have a risk-free rate of return on your money at 4%, right? That's how this stuff works. And right now, I don't see that being worthwhile. Hence why I'm obviously in predominantly cash. Doesn't mean I can't make money in the market, because I can, which I have been, even while being in cash. But maybe in the next week, I'll show my performance percentage for the account. But moving on, that's one. Another one is we have unemployment at lows. So we have unemployment at lows. I don't have the exact number. We have payroll numbers, job numbers doing good, meaning there's new job openings, jobs are getting filled. A lot of people are employed. A lot of people are, working. So that shows you that the economy is productive, it's strong, it's working. We have obviously inflation, like we know, at 3% annualized, obviously not factoring in what the next print is on Thursday. We also know that GDP is at 2.4% annualized as of Q2, okay? It was well above the 1.3% estimated. So the economy is running hot. Now, to the layman, the average person, be like, Riz, these are all good things, like unemployment being low, jobs numbers being fine, GDP being very strong. This is all good stuff. These are all things that, wow, this is what an economy wants. And to that, I would say, absolutely, you would be right. But looking at it in the future, how much lower can unemployment go? It can't go to zero. It's just not functionally possible. So I feel like maybe this is as good as it gets. What about jobs numbers? We know that we're not overall in aggregate, especially in the tech sector, we've seen job cuts. We've seen more automation. We've seen more companies downsize. It's not widespread yet, but it is there, especially in the tech sector. We've seen, like, just something recently, Yellow, which is a large trucking company, they went bankrupt. There's, I think, a few thousand people that are now unemployed. They just got their pink slips, like, you're done, right? You gotta look elsewhere. There's no other option. There's no like, hey, we'll call you back when we need you. No, the company's gone, right? So that's just one example. We also know another big thing that I feel like the market is kind of overlooking, and maybe quite a few investors and traders are, is potentially, unless something else happens, God knows, the government decides to step in, but we know that student loan repayments are scheduled to start in October. And some of you may think, October, Riz, we're in August. And to that, I would say, yeah, but I don't have student loans, and maybe you don't, but the people that do, it's probably tickling in the back of their head that, whoa, maybe, I hope so at least, like, oh, I have this thing coming up and I haven't had to pay these, or I haven't been on the hook or responsible for them for the last 2-3 years due to the freeze in payments. Maybe if they're like fiscally conscious and responsible, they're like, I got to start paying this. Maybe it's $200, $500, whatever a month. That's $500, $1,000, whatever, less that they have for discretionary spending. That is going to make an impact in broader economic principles in every single way, whether it's affordability for rent, affordability for mortgages, affordability to buy stuff from Amazon, affordability and the capacity to buy iPhones, to buy clothes, to go on vacations. They will matter. How long it would take, that's anyone's guess, but they will matter. Unless, I'm not getting political, but unless the current administration finds another way to defer, delay, bypass, I don't know, right? Forgive, whatever the case is. And however you feel about that, it's not my purview. I'm just telling you the fact that student loan payments are looking to start back up in October. We also know one thing. We know that Treasury bond yields have skyrocketed. We've been touching on that the entire year, Chris. As you know, we've added that metric the last few months. I think it's the start of the year actually, where we started looking at bond yields, and they've run up quite a bit, even if you look from 2022. We know the yield curve is inverted, as we assured. It's actually been inverted for quite some time. And here's another statistic for you. Usually it takes 11 months to 2 years, sometimes 2 years when we look back. It's not a perfect indicator, but usually around 2-year mark is when we see a recession occur post first yield in curve. Okay. Last but not least, the Fed has continued to signal, Jerome Powell specifically, that they could keep rates, forget raising rates, they could keep rates at these levels. So at 5%, 5.25%, they could keep them well into 2024. Okay, that's still pretty much half a year from now. Okay, let's say 5 months from now. And that's assuming they drop them in the start of the year. They might not. It could stay at these levels well into potentially mid to end of 2024 even. People and the market have now factored in an increased cost of living plus an increased borrowing cost, whether it's for mortgages, loans, credit cards, car loans. They have not factored it in, and I think the market hasn't factored in either. So this is me potentially being a bit early or ahead of the curve, again, if it even happens, but I'm willing to put my thesis out there. I'm willing to stand by it. Obviously, I'm not going out and shorting everything, but because I have that cash. Cash is one of the best hedges, obviously, and as the strategies that I utilize and students in Elite as well utilizes the strategies that work and are able to generate returns even without having to constantly buying everything and constantly having to chase the next growth stock and momentum stock, right? We can generate cash on our capital. We can generate income on our capital. We can do a whole bunch of methods, right? Which students know about. So that's my purview. That's my thesis. And that's my kind of view going into the next few months. And I feel like I wanted to come out and make that clear in a more precise data-driven way, as opposed to just saying, hey guys, I think the market could go down. I think this is just a better way to do it. Now, notice how I didn't give a timeline. Why? Because I'm not in the fortune telling business. I'm not in the forecasting business. I'm in a building my thesis and putting it into action type of business. I'm in a risk management business. Okay. That's a thing that people do not really realize. They think, well, you're in the trading business. Well, yes, but I'm actually in the risk management business. When you build a capital and wealth and asset portfolio like mine, you are, whether you like it or not, in the risk management business, because you will notice for elite members, especially the way I trade, I'm not looking to squeeze out hundreds of percent. I'm not looking to buy and carry for years. I'm not looking to, do the things that maybe other people might do because they want to grow their accounts extremely fast or take aggressive types of stuff, because I don't need to. And I know that some people might need to, and it's fine for them. But with the account sizes, the capital, the assets that I'm dealing with, a lot of it in markets, a lot of it outside markets, I need to focus on capital preservation. Growth is important, but capital preservation. And I think 10 years of beating the markets, I feel pretty good in my philosophies, my strategies. I know I don't want to, keep beating this horse on it, but I think when I share my next week, maybe during the week on social media and in the week, I'll share what my performance is. I don't want to give too much away, but my performance has been pretty decent, and we'll directly be able to compare it with the broader market performance. And I can tell you I'm beating the market. I think that's obvious. So this would make it the 11th year in a row that I've beaten the markets. So, you just do the math roughly, and you could see how compounding works. Even in the last few years, I've diversified. Again, that's a whole different conversation, but it's been a phenomenal run. I don't plan on hanging it up anytime yet, right, Chris? But I think numbers and the data speak louder than words, and I believe that. Hence why I share ups and downs and with explanations.
Yeah, we're definitely not going anywhere. And great analysis, guys. You're not going to get this analysis anywhere else, if you ask me. So thank you, obviously, for being here for that. I did get a private message while you were talking about the macros here. Wanted us to take a look at a couple of tickers. It says that he's in, and this is a private message, so I'm not sure if he wants to have his name revealed or not. So we're in INTC at 34.50, and he wants to know for both of these. The other one's Meta. We'll get to that one in a second, but he wants to know whether he should hold or let it go. So we're basically up about 60 cents per share here on Intel. Obviously, I don't know the sizing or anything like that, but I mean, obviously, this technical pattern looks pretty decent. I mean, we're in a very nice uptrend here on Intel. So from that aspect, I would say, oh, you should totally hold it. But looking at broader markets with everything that Riz just talked about, and with potential for more downside on Monday, could be something to just keep an eye on. Riz, if you were in at 34.50 here, what would your plan be?
Yeah, the cost is 30. Sorry, what was that?
34.50
cost. Okay. I would look to see if we can run it up there. It's right at 35. Run it if it's past 34. So like Friday was obviously a good day, so you're in slightly profit. It actually had a nice relative strength day on Friday with everything else being down. Not everything, but most things being down. Intel being up is quite the positive surprise. They had good earnings too. What I would do is I would put a stop at the very least at your break even. Simple. Do it. Continues to run, great. Pulls back, screw it, you're out. The fact that it's made this recovery, usually Intel completely shits to bed, usually post earnings, but this time they actually, did decent. They actually gapped up. They gave it back, but they gapped up post earnings, and it wasn't too bad of a quarter either. Not too big of a fan of the management and the company. It used to be an absolute juggernaut and powerhouse, but they've given that back. They've really kind of dwindled in their massive lead and massive market share that they had. They've really lost quite a bit into AMD and NVIDIA. So that's not great confidence inspiring in management. So factoring all that, put a stop. Honestly, 34.50. If you really want to risk a little bit, 34, and see if it runs. If not, if you feel like, you just want to get out, take this off, I can't blame you either after Friday's momentum, especially if we see a little bit of a pullback. Maybe Monday it's red. If it's red, then this may potentially go down too, and then you might be like, screw it, I'm getting out. And I can't fault anyone for doing that.
Yeah, for sure. That's definitely a very safe play to do. Having your stop in place, always a good thing. All right, so we're in Meta at 318. Oof, we're getting a little hit on this one. Looked like trying to pull a little bit of a Riz here and get it close to the top. If I had to guess, I'm going to say we got in post earnings. Of course, I don't know for certain, but sometime here in post earnings, and yeah, we dipped a little bit. Of course, we got pulled down definitely on Friday thanks to Apple. Typically that's what we refer to as a sympathy move, but of course the market was down as well. So yeah, so we're down about $8 per share on this one because we're in long at 318. Obviously, we're past the point of a break-even stop. I don't know. Me personally, I wouldn't let it run past 300. I think that would be my absolute line in the sand. But where are you on Meta, Riz?
I agree. Yeah, 300 is that kind of sweet spot as well. It also right at that gap fill lower.
Yep.
You said, this person maybe entered post earnings, right around earnings, maybe before. What if, again, I don't know who's, but what if we scroll back further, what if they're actually an absolute beast and held through this drop from
Yeah, like in here.
2022? Yeah. Yeah. I mean, I laugh because not from a to make fun of, but I feel like, holy fuck, that's epic. That would be quite the ride, right, Chris?
It would be. He just messaged me. He said it was post earnings, so he is
Okay, he
not
said
been
post
holding.
earnings. Okay,
Yeah.
sorry, I missed that. Okay, yeah, post earnings. Yeah, I mean, not an ideal entry to be honest, but yeah, I would not let it go over below 300,
Yep. I think
especially
that's
with
fair.
especially with a recent entry, like that. I would not. That's not the most optimal entry personally, but hey, it is what it is.
It happens, and even Riz can have suboptimal entries, as we heard earlier. So it's one of those things that does happen, and sometimes you just got to bite the bullet and say, you know what, I'm messed up. We're just going to let this one go and deploy capital elsewhere in case another opportunity goes. But giving yourself that space gives you a little bit of cushion to let this run, and maybe it does dip a little here. Maybe a little more, and then we get some uptick in the market and we start pushing back, towards the upside. Giving yourself that space, between here and 300 will allow you to let it run a little bit and hopefully start moving in your favor. All right, awesome. Well, I'm not seeing any other questions, and I think Riz, you did your macro analysis there, really solid. So I want to thank everybody for coming out tonight. It was great having everybody. Amazing questions, and as always, and thank you, Riz, of course, for being here and giving us your in-depth market knowledge. I think it really was a great webinar tonight, and I think a lot of people should learn from this and how to get that trader's mindset. That's something that takes a lot of work.
Yeah, absolutely. Especially a little bit of a long special webinar. Hopefully everyone enjoyed it. Yeah, I really wanted to kind of take the opportunity to kind of demystify not only what happened on Friday, but of course the goal I came in with or planning was before Friday to come in and actually explain my views for the coming few months into next year. But of course, Friday opened up a whole nother opportunity to explain what happened there.
Absolutely. Thank you, everybody, for coming. And as always, we'll see you in the market on Monday.